Good afternoon. My name is Tom Turk. I'm the Dean of the Arduous School of Business and Economics here at Chapman University, and I want to welcome you to Tearing Down the Pink Wall. We are delighted to be co-hosting this with WISE. Both WISE and the Arduous School are committed to inspiring and educating women to take on leadership roles in the financial services industry, and we do it through events like this. In addition, through the fabulous work of Fidel Lawandi, director of our Janes Financial Center, we provide an incredible range of opportunities for women seeking careers in financial services, from Bloomberg certification to Wall Street prep courses to CFA competitions to managing our over $3 million student managed investment fund. There's all kinds of opportunities for people trying to pursue careers in financial services. And while 2020 has not been a great year for a lot of people, it actually has been a great year for the Arduous School. We just celebrated our 20th anniversary of being named the Arduous School of Business after George L. Arduous, and we had an incredible gala that featured President George Bush here this fall, raised over $15 million in one night for the Arduous School for programs like this. But in addition to that, we were ranked among the top 75 graduate business programs in the world by US News and World Report. In fact, we're the third ranked private business school on the West Coast, behind only Stanford and some school up in LA, I forgot their name. But we're also ranked, our Business Week ranks our undergraduate programs 37th in the nation and number 1 in California. So we're delighted by the recognition we're starting to receive from the impact that we're having on the community. And it's events like these that make it special. The opportunity for our students and our partners to meet with leaders in the financial services industry, especially now with so much uncertainty. The market insight that we're about to receive this afternoon is something I'm sure we're all looking forward to. But before we get started, I just want to thank a couple of our sponsors, the CFA Society of Orange County. We appreciate your support, and Miracle Mile Investors, a great partner to the Arduous School and to WISE as well. Let me introduce now to you Angela Daly, who is the co-president of WISE. Angela was one of the founding partners of DAI, which is a strategic communications business that focuses exclusively on the financial services industry. And they've been operating for over 30 years, providing those specialized services only to financial service companies. Before that, she worked at Drexel Lambert for 10 years. She was the senior vice president and headed their global communications. In fact, she was on their board of directors, one of the first women to be on the board of directors of a major Wall Street firm. She's written extensively on reputation management and has done all kinds of volunteer work, from serving on the board of the YWCA of New York, the Financial Women's Association, and so many other organizations. So to kick off the program, I give you Angela Daly.
Well, thanks, Tom, for the kind words and very impressive accomplishments for the Arduous School. Congratulations. Well, hello, everyone. Welcome. Thank you for joining us. We'd hope to have this event in person, but here we are in virtual format, which has a lot of advantages. For the first time, WISE is able to welcome participants from all over the country. And in fact, we had over 400 sign up for this event. So it's very exciting for us. So don't let location stop you. Go to our website, wiseinvestors.org. Sign up. You'll hear about our events. The price is right. It is free. WISE has been fulfilling its mission of financial education for women of all ages and all economic strata since its founding in 1997. We do this because we believe that better managing your finances will give you more opportunities in life, more security, and the ability to fulfill your dreams. We do this through events such as this one, workshops, and in partnership and collaboration with community organizations such as Girl Scouts, Girls Inc., and universities. So far this year, we've reached about 1,200 females of all ages, and I do mean all ages. We even work with the daisies at the Girl Scouts, which is one of the highlights of our year. Tonight's event is part of our groundbreaking series, Tearing Down the Pink Wall. As Tom mentioned, its objective, its mission is education and inspiration, so for all women to achieve their maximum potential. We have an incredible panel for you tonight. We have Erin Browne, Jane Buchan, Katie Sherritt. All three of these women are on the Barron's 100 Most Influential Women in Finance 2020. Just think what a privilege it is for all of us to hear from them, their market insights, and about their career paths that led them to the highest strata of the investment world. But before we go into our program, it is my great pleasure to introduce Consuelo Mack. Consuelo and I go back a very long way. We started our careers in New York about the same time, she in financial journalism and me on the dark side in public relations for a controversial investment bank. So as fate would have it, our paths crossed many times and we became close friends. I can tell you firsthand that she is one skilled interviewer and a lot tougher than she looks. Consuelo was one of the most respected and admired financial journalists in this country. She was an anchor on CNBC. She hosted a show on that network. And now for the past 15 years, she's had her own show on PBS WealthTrack, whose mission is to help all Americans build and preserve their wealth. Consuelo's professional credentials are impressive and just impeccable. But what really distinguishes her is her character, her devotion to her family, her friends, and the community on which she serves on a whole variety of boards. And one that is very near and dear to her heart is the Museum of American Finance. So she's here with us tonight, demonstrating her commitment to financial literacy. So please join me in welcoming Consuelo Mack and our distinguished panel.
Thanks, Angela. You are the best. You are a star. And for anyone who's looking for someone to represent them in the financial services industry, I would highly recommend Angela. When she calls with a client, I immediately pay attention. So thanks so much, Angela, and for all the work that you're doing for women and for financial literacy. It's really important. And I know it takes a lot of work. So I want to thank, Wise and Chapman and Tearing Down the Pink Wall and for organizing this event, and especially in enlightened self-interest. I want to thank you for including me in this event, because I feel like I've won the trifecta. As Angela just said, it is incredible that the three panelists that you're about to meet have each been named in this year in this Barron's 100 Most Influential Women in Finance list. And Angela had asked them to participate before we knew about that. I think it was an inside job, quite honestly, but that will be another discussion. So let me quickly introduce our panelists, because you've seen their bios before this started. They are each top professionals in their field, as Angela said, and they come from different disciplines. And the world of finance is fascinating, and it is a wonderful place to have a career, which the three of them will attest to. I mean, it's diverse, it's chock full of opportunities, it's dynamic, and you're constantly learning new information. So I'd hardly recommend that anyone who is in the audience should look into the financial services industries, because it is a terrific area to get involved in. So the neat thing about this program, as Angela said, is that it's a two-parter. So we're going to talk about, first of all, the state of the investment climate. There's a lot going on, as we all know. And also, we're going to talk about their career paths, and how they basically made their way to the top. So back to their bios. So Erin Browne, you saw, is the managing director and portfolio manager at PIMCO, which is a global leader in fixed income. Anyone in California knows this, but it's got $1.92 trillion of assets under management. It is huge. It's a leader and has been for many, many decades. But what does Erin do? So Erin manages asset allocation strategies, including PIMCO's multi-asset funds. And she also leads the Glide Path Leadership Team, which oversees PIMCO's what's called the Real Path Blend Target Date products. So she's in charge of the target date products. That we're going to talk a lot more about all this in a minute. Jane Buchan, who is fabulous, is a CEO at Martlet Asset Management. And that's an independent investment firm that she founded in 2018. And prior to Martlet, she was the CEO and co-founder of PIMCO, which is a fund of hedge funds that she started in 2000. And by the time she left the firm, it had $32 billion of assets under management. So she is our expert in alternative investments. Then Katie Sherrod is partner and CEO of Research Affiliates. That is a global asset manager known for its award-winning research and also its innovative products. And Research Affiliates founder and chairman, Rob Arnott, is a pioneer, and he pioneered fundamental indexation, which weights stocks on fundamentals. It's a really neat idea. It's a good idea, like the size of sales, profits, and cash flow instead of market capitalization. And Research Affiliates now has about $142 billion of assets worldwide that are using its investment strategies. And the firms that are included in the firms that are using Research Affiliates investment strategies is PIMCO. And PIMCO was an early adapter of fundamental indexation. And as a matter of fact, PIMCO and Research Affiliates introduced the first fund that was based on fundamental weighting of equity indexes. So Katie oversees what does she do? Well, she oversees the operations and resources of the firm, including the establishment of strategy and policy. So welcome to all of you. Thank you so much for being here and giving us your valuable time. So part one of our conversation is the investment climate. And let me quickly just, list a couple of things that are going on that are affecting what is happening in the investment climate. A global pandemic, for instance. We've got rolling economic openings and shutdowns. This is global again, unprecedented monetary and fiscal stimulus. We've got, record levels of corporate and government debt. We've got historically low interest rates. We have wide market divergence. U.S. large cap tech stocks have dominated for the last decade. Growth is, dominating value. Large cap over small cap, U.S. over international. Gold has come back. Real estate is making a comeback as well, taking off. Private equity's popularity. We could go on and on. So what should we be paying attention to? And that is my first question to our panelists is, what are they paying attention to? So Erin, I'm going to start with you. What is your perspective from PIMCO? What are the top 1 to 3 macro themes, short-term and long-term, that you are paying attention to that we should?
Sure. Yeah. And I think it's certainly a pertinent question and one that we get a lot from investors currently. I think what we've moved from is the chronic phase of the economic crisis to more of a, sort of persistent phase that we're moving into, where we're expecting that growth is going to continue to rebound, but at a much slower pace than what we've really seen over the last 6 months or so. We started to see a lot of the economic data start to level out. At the same time, we started to see some reversal in the reopening. Most notably, we saw New York City take a couple of boroughs and lock them down over the last 24 hours or so. We've seen similar moves in Europe and similarly in Australia as well. And so I think as we move over sort of the next couple of months and into 2020, we're really thinking about what is the environment going to look at. And I think what we've seen is a lot of the themes that we thought were likely to happen over the next 5 years or so have really been accelerated in the near term. And, that's a persistent low growth environment with persistently low real yields or nominal yields across the interest rate curve. In addition to that, low inflation, and an environment where we think that, we're likely to remain in over the next sort of 3 to 5 years is going to be sort of this persistently low growth, low inflation environment. And so what that means is we're really looking to diversify pretty aggressively our asset allocation across risk assets. We don't want to be too heavily weighted in equities relative to bonds. We do want to take a pretty broad breadth in terms of what we're, investing in. And the themes that we really think are likely to persist over the next couple of years is one, I think, what we've seen in California over the last year, over the last 3 years or so, is a focus on environmentalism. We think ESG is likely to be a really persistent theme that is going to continue to grow, both in the mind share as well as the wallet share of investors over the next 3 to 5 years. Secondarily, we think that you'll see more aggressive fiscal action, whereas the last 10 years or so, we've been in an environment where monetary dominance has really ruled. We think we're likely to move into an environment where fiscal takes a little bit more of the burden off of monetary. And that has, I think, pretty significant implications for risk assets and as well as for interest rates. And then lastly, we think that we're likely in an environment where the U.S. is not likely to outperform to the same extent over the next 3 to 5 years as it has in the last decade. And so that means that a little bit more of a rotation into world assets away from purely a U.S. Oriented portfolio, we think makes sense over the secular horizon.
All right, so, and we'll drill down to all of those in a couple of minutes. So Jane, we heard diversify across all assets, and you represent the alternative asset universe for us. So what's your perspective of what we should be paying attention to as far as when we look at the entire investment climate?
Thank you, Consuelo. I call this the Rip Van Winkle market. I don't know if you remember the story of Rip Van Winkle, but he went to sleep for 100 years and woke up. If you went to sleep at the start of this year and you woke up yesterday morning, with the exception of some big moves in energy, not much has changed. However, in March, we saw extreme moves, even larger than in 2008, in terms of volatility and very, very thin markets. So we're sitting at this very crazy place in the world, which is, we shut down our economy ourselves. We've never done that before. We've shut down global trade. Are we in the position that this was like we just stubbed our toe and we keep walking down the sidewalk and everything's going to be fine, which is how everything is now? Or is it that there are going to be fundamental shifts in the economy? And, as Erin mentioned, ESG is important. That's reflecting a lot of the energy use. But by and large, we have two different views. And what I'm seeing when I work with a lot of investment committees is they seem to have picked one camp or the other. I was trained as an economist, so I have two hands, one hand one way, one hand the other way. And so I'm still waiting to see.
And just run that by me again. So the two choices are we going to continue along the same road?
Right.
Which is what the stock market is kind of reflecting, or what's the alternative?
The alternative is you get a real serious slowdown. There's a lot of leverage in the system. You see a lot of actual real economy hurt in terms of layoffs, in terms of the inability to meet debt payments. And you see a lot of particular credit assets get very, very hurt. So I don't know which way it's going to go. Okay. You can't have the credit markets fall apart and the stock market to keep going up. That's the one thing in this world I'm sure of.
Right. True. I think most of us would agree with you on that one. It's very perplexing of why there's been that tremendous divergence. Katie, from Research Affiliates, kind of research and product point of view, your views on the investment climate.
I think the other panelists have made some really good points. It's really hard to tell what's going to happen, although anybody that knows Research Affiliates knows that our investment beliefs are very value oriented, and we believe in long-term, long horizon mean reversion. We believe that the value growth spread, it's unprecedented how much of a discount value is to the growth stocks right now. It's not sustainable. We are concerned, the US market is priced to be flat over the next 10 years. Based on our research and numbers, it's readily available in other sources. But we're worried about the US market. We see better, as value investors, we see better pricing, better bargains in other markets. Rob's famous for citing emerging markets as having more attractive prices. So it's hard to say where we're headed, uncharted territories, but the U.S. market is a little bit rich for us.
Right. So, the assessment, let's talk about the assessment of valuation levels then, and in the various markets. So, Katie, at Research Affiliates, you're basically saying emerging markets look very cheap. U.S. markets look overvalued. I don't want to put words in your mouth, but you're always looking for values and growth over, I'm just small cap, large cap, U.S., international. So you're basically favoring all of or looking towards all of the sectors and the markets that have lagged over the last decade. That's where you're seeing the
Yeah,
values.
diversification hasn't worked. I think Erin said
Right.
this. Diversification has not worked much in the last decade. Particularly for U.S. investors, the U.S. stock market's been pretty much a one-way market, which doesn't bode well for value investors or for people who rely on diversification as a core tenet. So the strongest statement we would make is that the discount of value to growth stocks is so large that we believe pretty strongly, we've written a lot about it, I've done a fair amount of research.
Right.
We believe that the value will bounce back, spring back, and have a much more typical, if not overshoot, before it comes back to a more typical relationship to growth. And that's what we expect. And I think it's most extreme in the U.S. markets. Emerging markets have also been beaten down. They look cheaper to us on a relative basis. But I think that our big message is that the current relative pricing is just not sustainable.
And markets can remain irrational longer than investors can stay solvent. So, these trends can last a long time, whether or not they make sense or not. Erin, I mentioned, historically low interest rates. When interest rates decline, bond prices go up. So as far as valuations in the fixed income space, what's your assessment?
Yeah, I think that in order to have a really bearish case on fixed income, you have to believe that, one, that the Fed is not credible with their view of holding interest rates low for a very long period of time, or in addition to, two, that inflation is likely to rise significantly from here. I think that structural dynamics over the next 5 to 10 years are going to continue to create headwinds for inflation really significantly rising. Yes, I do believe that the Fed is committed to trying to raise interest rates to at or about 2%. But I think they're going to be met with challenges in order to do so. And if they're likely to get there, I think they're going to be hard pressed for getting interest rates or getting inflation rather significantly above. Yeah, inflation significantly above 2% at a persistent level. So, my view is that, fixed income yields, while ultra low, are also, make sense in light of the fact that we've seen pretty significant declines in, total potential growth in the U.S. and across many developed markets. And, while we could see, intermittent bouts of interest rate volatility, we're likely not going to be at significantly higher interest rates in, 2023 than we are today. And I do think that is quite supportive for equity valuations. Yes, on simplistic measures, just going back to sort of earlier comments, I think that equity valuation looks expensive, but when you look at sort of the total available sort of stock of assets that you can invest in and relative valuations across asset classes, equities don't look nearly as expensive as a simple sort of CAPE or Shiller PE estimates would would have you believe. And so I do think that equities can stay, well bid because of the ultra low interest rate environment that we're in, which is being artificially supported absolutely by the Fed, but it's likely to continue to be, artificially supported by the Fed at least over the next several years.
There is this theory called TINA, there is no alternative. And if you look at,
exactly.
at what the returns are in fixed income, stocks in comparison, look relatively attractive. Jane, you're nodding your head. Valuation levels with hedge funds, for instance, and then I'll ask you about another alternative investment. But when we've been in this bull market, hedge funds have not been looking so great.
Yes, it's been very hard. I mean, to be candid, if you aren't in a subset of tech stocks, the so-called FANG, everything struggled. I mean, small caps struggled, value struggled, all sorts of things have struggled. The value of hedge funds, in my view, is to be a diversifier that's pretty consistent. If you look at them, they're up several percent this year. They drew down about 5% on average in March, but that was a lot less than the stock market.
So they worked.
They worked.
When needed, they worked. Right.
They worked. You know, I think some of the press likes to paint pictures of hedge funds or the mythical, George Soros breaking the Bank of England and up 100%. But that's not what most hedge funds do. Most hedge funds are relatively conservative. And what we're seeing is actually, while there are some, I agree with Erin, there are some really good opportunities in bonds, we're also seeing a lot of pension plans and other long-term investors move money to hedge funds because, frankly, the rate of return there is probably greater than you're going to get on a lot of fixed income investments. And by being able to go long and short, if the market were to fall apart, the hedging, the being short can help tremendously.
What about private equity?
Yeah.
There's a lot of money has flown into into private equity. Some people are saying it's that it's too much money chasing too few good prospects. What's your view?
Yeah, one of the interesting things, and we've tracked this for a while, is you can see where deals get sold from one private equity player to the other. And when you think about the story about private equity, which is we're going to take a company and we're going to focus on cleaning it up internally. Well, but if you're trading it to another private equity company, I'm not sure, who's the greater fool there. I think where we're seeing a huge interest, though, is private debt. There's, in terms of the banking system today, it's hard for a lot of people to borrow $25 million. $50 million. You may be wanting to build a new plant. You've got a lot of delivery vehicles. You can collateralize the loan. People aren't really interested in it. In many ways, the big private equity players are very tight with the big banks. And so if you're not a private equity deal, so we're seeing quite a few investors want to directly lend to companies, which is very interesting because it's really putting them in much more of an operating position than being a passive investor. Now, they'll use asset managers for this, but it's a very different perspective.
And Katie, from Research Affiliates perspective, you're creating products, you're doing a lot of proprietary research, basically to offer better solutions for investors. So at this particular time, are there certain types of products that are more suitable for investors when we've got the market at some markets at crazy levels, both extremely high or extremely low?
Well, we would always say cap-weighted equity products are a poor idea, particularly right now with the fan mags. So obviously we would do anything we offer that's not heavily weighted to the top companies would be better than going with a cap-weighted index, in our opinion. But I'd like to come back to a point that Erin brought up and Jane commented on. I think ESG, particularly now in this COVID environment, we're getting a lot of inquiries on ESG. People are
so everybody knows what that is. It's socially responsible investing. It's environmental considerations, social considerations, and governance considerations. Just
exactly. And I think what we're seeing is a lot of demand. We do not only the indices that are published, and we partner with firms like PIMCO to create funds and ETFs, but we also do a lot of custom work for bigger individual clients. And a lot of them, particularly Europe, Australia, are interested in low carbon or climate transition solutions. And they want to build that on top of, let's say, you mentioned fundamental index on top of a RAFI or a multi-factor product that's in the market, the generic form. And we're seeing a lot of interest, a lot of talk from clients who want to take a more active role in having their investments reflect something other than purely risk and return. We believe with financial engineering, you can do that. You can keep the performance profile and allow investors to achieve their other objectives. So I think that's going to be huge as people look at environmental issues, carbon, and particularly social issues. Not clear that everybody does it, particularly not in the United States, but we're starting to see a big increase in interest.
Right. And the rap on ESG and socially responsible investing for a long while was that you were giving up performance because you were basically excluding, entire sectors from your portfolios. But the research over the last 10 years or so has shown that that's really not the case, right?
Doesn't have to be the case.
Yeah.
We've replicated some research. It doesn't have to be the case. And when you get into, if you really get into the financial engineering or designing your products carefully, great study, Fabozzi, and I can't remember his co-author right now, did published a piece of research basically saying that the sin stocks are really quality stocks. And one of the reasons that they do better, in the adage you refer to, Consuelo, a lot of people say you constrain the index or you take out something that is socially shunned, it'll have a higher expected future return. And so why would you take that out of your portfolio? What Fabozzi and his co-author showed is that actually the sin stocks are just quality stocks. They're highly profitable and they don't invest a lot. And that is a factor that you can capture in other ways. You can find other ways to capture quality and add that back into your portfolio. So you don't have to give up the returns of a sin stock if you engineer your portfolio well. So there are lots of things coming together.
Lots of things happening.
Lots of things. Depending on the portfolio design, you do not have to give up your return to achieve these objectives.
Right. Let me follow that, the ESG theme. And Erin, it started in equities, but it's also moved into fixed income. So PIMCO is involved in ESG products as well. And I think, Katie, you just mentioned that maybe they're doing some things with research affiliates too. But Erin, what about ESG and fixed income?
So actually, PIMCO's been investing across ESG lines for the last 20 years. We were the first to actually have an ESG fund in the 1990s, and have obviously grown this as a part of our practice significantly over the last decade or so. But at PIMCO, we have over 80 sector analysts that follow different credits within the corporate credit world. Each of those credit analysts, for all of the universe that they cover, they have to give an ESG score to each and every single corporate credit that they investigate, that they research. And so we have, thousands of corporate credits that are rated according to their ESG score. We can actually use that same corporate credit rating, that ESG score that they use for the corporate credits, for the equity instruments as well. And then we also are devising a way to evaluate different sovereign credits in terms of sovereign issuers as well, based on ESG metrics. So it's something that PIMCO is heavily devoted to. We spent a lot of time really developing our own internal framework for being able to appropriately rate according to ESG metrics, fixed income, really across asset classes.
And Jane, does it have any relevance to hedge funds or private equity?
You're seeing more talk about it, but there are very, very few products that are in there.
Right.
I think one of the things to remember about ESG is many of the tech stocks have historically been light on ESG. And so with the FANG rise, you've gotten really good performance. And then with energy slowing down because of the coronavirus, they've gotten killed. So a lot of it, you've got to be very careful and understand, whether it's the fundamentals of the company that are driving it or it's just the sector that it's in. But we do see people are very concerned about it in terms of the ability to make money. And clearly, as consumers vote with their feet, if this is what they believe in, you're going to see that reflected in the revenues. And then that's going to affect whether an alternatives manager is going to want to engage.
Let's talk about investment strategy in general. And Erin, I'm going to get back to these ultra low interest rates because, given the fact that bonds are supposed to be, number one, provide you with income and defensive characteristics in your portfolio. But right now, you don't have much income from bonds. So what role does fixed income play in a portfolio these days?
Yeah, so, I think it's a really pertinent question, and something that a lot of our institutional clients are really focused on right now is whether there still is value to fixed income, and whether 60-40, which is 60% equities and 40% bonds, which has delivered over 10% over the last decade, over the last 30 years or so, in excess of 10%, if that's dead. My answer is always no. And I think that the first quarter of this year has really highlighted the value of fixed income, where we started the year at very low interest rates by all accounts, and certainly across the globe we had negative real yields in Germany, across much of Europe, across much of the U.S. or in the U.S. as well, much of developed markets. But yet, despite starting the year at low yields, we were able to fall significantly lower through the pandemic, and even today, where interest rates stand, they're still, over 50 points below, sort of the pre-pandemic levels. And so, I think that shows that there is still resiliency within fixed income yields, even despite very low starting points for where yields are today. Secondarily, I still do think that given the narrative that we've heard from global developed market central bankers over the last 6 months or so, the likelihood that they're going to surprise markets and raise rates at any, sort of time soon, I think is very low. And so I do think that as a hedge, as a risk off, sort of hedge, they still offer value within portfolios. The second point, I think, though, is where do you get that income? And I don't think that you're going to get much income from, obviously from developed market fixed income. I do think that you're going to have to look at outside assets that offer value. One of the places that we're looking at, it's a little bit more esoteric maybe for this audience, but is emerging market local currency bonds, which we hedge back into U.S. dollar, which still offer about 200 basis points over relative developed market yields. We're also looking at investment grade credit on the short duration investment grade credit, because that also offers, safety because it's investment grade. These are high quality corporates, but they also offer, a pickup in yield relative to what you can get in, sort of sovereign yields and developed market sovereign yields like U.S. Treasuries. And then I think there are other ways that you can sort of look for yield. One of the popular trades that we're starting to see more hedge funds going to, as well as some asset managers, is looking at high dividend yielding safe equities as yield replacements for their fixed income portfolios. So think of a basket of consumer staple stocks like Clorox, like General Mills, that offer 2 to 3% dividend yields, which are higher than what you could get obviously in U.S. Treasury yields, and can offer some incremental yield pickup from what you can get sort of outside of equities. So I think there's a lot of ways that we're looking at this, and I didn't mention mortgages or munis, but those are two other asset classes that we think on a yield basis look quite attractive as an alternative to fixed income.
Right. So, the assets that you mentioned, obviously the dividend paying stocks at this point, they are priced accordingly, which brings me back to Jane as far as hedge fund strategies. And, how do you think about just the low income possibilities out there, Jane, and in the hedge fund world, and as far as the alternatives that could be actually alternatives to the traditional fixed income?
Yeah, so what we're seeing is people taking some of their fixed income, and particularly some of their treasury fixed income where there isn't a credit spread, and putting it into a well-diversified basket of hedge fund strategies with the idea to pick up 2 to 3%. As Erin mentioning, and there's various ways they're doing it. They're trying not to take a lot of directional risk, but we're seeing that. And then to Katie's point about where the equity market is, people are worried about the equity market, and that's the move to private equity because it tends to be more directional. And also venture cap. Ventures had a tremendously good decade. Mm-hmm. The decade before the last decade wasn't so hot, but this past decade's been great. And we're seeing a lot of people buy that long direction in the private markets because the idea is they've got a holding period of 10 to 20 years, and that's what they want to do.
So it's interesting, you know, Katie, when she mentions that they've had a great decade, I'm thinking of your reversion to the mean comment. And so I'm sure that at Research Affiliates, you're looking at these asset classes that have had a really good run. And, you know, you probably are taking the opposite view at this point. Do you want to just kind of discuss anything about you've already discussed some of the investment strategies. Are there some other things that you all are thinking about at Research Affiliates, again, in this very unusual environment that we find ourselves in?
Oh, I think for the audience that we have today, we have a kind of a public service interactive site on our website, Asset Allocation Interactive, and it forecasts 10-year returns using our core methodology in all the different asset classes and regions of the world. And rather than go through those individually, I think it'd be fun for people to go, particularly the audience here who wants to familiarize themselves with some of the things we're talking about. It's a very simple Research Affiliates website, and it's our Asset Allocation Interactive, and they can get some of the asset classes. We don't have all of the alternatives that Jane would be able to reference, but we certainly have the bond classes that Erin's talking about and equity classes and geographic range.
It's a great resource. So let me ask all of you a couple of things just quickly. Biggest risk to investors, Erin?
Yeah, I think it's a second wave of the coronavirus and a slowdown in the economic recovery.
Jane? Biggest risk to investors in the current environment?
In addition, I agree with Erin, but the second thing I throw in there is liquidity.
Mm-hmm. So tell me about that, because you know the kind of the belief is that the Fed and and governments have flooded the system with liquidity, but you're concerned about liquidity. Why?
The Fed has flooded the system if you're a big corporate entity. But if you're an investor and you want to try to get out, you need to be careful and pay attention to where the liquidity is. And we're seeing that relatively small volumes can move a fair amount. And so we're seeing that very much. The markets aren't as liquid as the volume would indicate.
All right, so that's really interesting. That can cause big problems. Katie, biggest risk to investors? What are you thinking about it at Research Affiliates?
I'm going to take a different tack given the audience and say I think one of the biggest risks for investors, individual investors, is chasing trends. For a lot of the reasons that we've talked about, it's very unpredictable, and the future won't look like the past. What do they say? The past performance doesn't predict future performance. Right. And I think we're in that kind of market, whether it's, as Erin said, because of so much economic uncertainty out there, whether it's liquidity issues, there are just a lot of uncertainty. And for people jumping in and basing decisions based on recent past performance, I think they could face some unpleasant surprises.
So let's think positively. Where do you see the greatest opportunities being created, Erin?
I think that the greatest opportunities are probably in the innovative sectors. I'm not giving up on tech entirely. I think that tech will continue to do well. But I think you have to look for new innovative technologies, disruptors that are coming out. We're seeing a lot of that out in Asia, in Japan, in China, in some of the sort of new tech innovations that are coming out there. I think that's going to have the greatest, sort of possibility for really significant returns over the next 3 to 5 years.
Jane?
Yeah, on the liquid side, obviously, I'm still a very big fan of hedge funds. You can buy whatever you want, go long, go short, hedge. So when you can use all the tools without a problem, I think you can do okay. And then the second, for really making large returns, I would go more towards the venture space. Again, following up, there's a lot of innovation occurring right now. I think we're going to come out of this at some point, and parts of the world are just going to be fundamentally different.
And is that accessible to individual investors, or you've got to be high net worth or an institution to get into the venture space?
I think by and large, you have to be high net worth or institutions, though there's some efforts now. I forget the names of them, but there's some of these efforts that are aggregating money for smaller investors. And you did see the SEC the other day change some of the requirements to make it acceptable to thresholds for people to invest.
Right, and more accessible. So Katie, greatest opportunities that you all are seeing at research affiliates?
Well, if you're a real big risk taker, you would go into emerging market value. But most people wouldn't want to put that type of risk on. So I'm a big believer in diversification and to diversify outside of the US markets. Make sure that you have a diversified portfolio. You're not betting. I agree. There's a lot of interesting things happening. Really hard to predict which company is going to capitalize on some of the opportunities. And it's very difficult to pick in advance. And so diversify, make sure that you have an opportunity to participate.
And there certainly are indexes available and, ETFs, mutual funds, whatever, in that space, which leads me to the next question for all of you is the active versus passive debate. Passive, the flows are going into passive. They are definitely attracting a tremendous investor interest. And there is a reason for that, at least in the equity space, is like for the last 15 years that, passive, and again, it's the S&P 500, it's the FANGs. That's what they always compare it to. So of course they've won over the average actively managed equity fund. So Erin, where do you come out in the active versus passive debate as far as fixed income is concerned? Is there a place where where active makes sense and where does passive make sense?
Yeah, so over the last decade, active fixed income has outperformed passive fixed income 76% of the time. So 76% of active managers in fixed income have outperformed passive.
All right.
In equities, it's 28% over the last decade. There's a pretty significant, sort of gap there. But I would say about active equities, I don't give up hope on active equities. I think active equities in certain pockets, whether it's small cap, whether it's emerging markets, have proven to be, been able to really generate alpha. And so I think you have to pick your spots. I wouldn't go all active or all passive. I think, playing active versus passive divide really depends on what asset class, what specific instrument you're looking to replicate. The other thing I would just quickly note on active versus passive is that, many managers, myself included, use passive instruments actively. So that's another way, I think there's definitely a role for passive instruments. It's, but I think you have to, be a little bit more nuanced in terms of how you play them.
Jane?
To me, it's not a choice because there's a lot of, the rainbows become much more colorful. For example, you have a lot of strategies now that have very small fees that tilt things. Katie mentioned they don't just accept the market cap weighting, and I think that's a very smart thing to do that Research Affiliates does. I totally agree with Erin that running a passive bond fund doesn't make any sense. When rates go down, your duration lengthens. Why would you want that to happen if rates mean revert? So I think it used to be a high fee. It wasn't active versus passive. In my view, it was a high fee versus a low fee issue. I think now you're seeing a lot more breadth, across a whole span of choices. And, the thing that you want to make certain is that if you're paying the high fees, you're really getting true active management, not passive management with a twist.
Got it. No, very important. Katie?
Totally agree with what Jane just said. Totally agree, because I think we're going to lose the active managers that don't really have skill. They're just charging too much money for what they're doing. And so there's definitely room for skilled active managers. It's good for the market, and there are people that can do it well. But there are also a lot of people charging high fees that aren't doing it well. And it can be replicated very easily with systematic rules-based approaches and delivered in a much cheaper, more transparent format like we do with fundamental index. I would like to take just a little digression, Consuelo, if you don't mind, because
yes, go.
When you say passive, I don't really know what people mean, because it could either mean the cap weighted index cap weighted strategy. Actually, I think of cap weighting as a strategy and index as a delivery, because fundamental index and many other strategies that are out there are investment strategies that are delivered in an index. So it's hard for me to know whether passive means it's delivered in a transparent index or is it the cap weighted benchmark. And so I think we as a profession can get a little better with our language, because as Jane mentioned, a lot of people are starting to put certain types of strategies out in an index format that could then be an ETF or a mutual fund or something. And they're actually taking active bets. Fundamental index is taking a lot of active bets, as evidenced by our performance this year. A lot of active bets versus a cap weighted benchmark. So I think we could do better at cleaning up our language when we describe products.
And you're right. Number one, your point being that the market's working in that the strategies and the active managers that aren't performing well and are charging high fees are losing. They're losing, and the funds are being shut. But also, when you think about traditional passive, you do think of where the bulk of the money has gone up until recently, which is like an S&P 500 index fund, whether it's Vanguard or whatever. But you're right, there's a lot more competition in that space, which is, yeah.
One other thing,
Yes.
you and I talked about it briefly. Rob and Jason did the research to create fundamental index not quite 20 years ago after the tech crash. Because so many investors were harmed by the overweight in a few names. I can't help but think we're coming up on a similar situation. And so that'll be another factor for investors, at least retail investors, to contend with going forward as they try to pick strategies.
Right. It's an exciting time to be in the financial services industry, and to be an investor, it's kind of a scary time. Let's switch to careers now. You three are kind of incredibly successful professionals. So I want to ask you about starting with, we're talking to an audience of some graduate students from Chapman and probably some undergrad as well. So let's talk about education and the foundation that you all chose, and you've got three different experiences. So Erin, you have a BA in.
Consuelo, may I just jump in? I'm sorry, I forgot to mention in the introduction that we are taking questions at the end. Use the Q&A screen, not the chat screen, and that's all I have to say.
Oh no, that's great, and we will have a Q&A at the end. So thanks, and I'm sure you've already gotten some questions. Thank you, Angela. So education, Erin, you got a BA in economics. How good a foundation was that?
For me, it was an excellent foundation. I do believe that a lot of what you learn is on the job. And I think, more now than ever, just because there are so many asset classes, there is so much, I think, that you learn in your first 1 to 2 years at an investment bank or at a trading firm or at an asset manager. But I do think having a strong analytical foundation is incredibly important. And that's what economics provided me.
Right. You didn't go for a graduate degree. The other two did, several graduate degrees. Why didn't you? And do you wish you had?
No, I definitely don't wish I had. I think that, for me, I realized pretty early on that finance was what I was passionate about. It's what I wanted to do. And I sort of fell in love with the industry and quickly progressed throughout my career. And so I think for me, I didn't see the need to go back to grad school. My brother did, and he is a year behind me. Yale undergrad, went to Wharton grad school, followed a very similar path to me, and we're at very similar sort of places in our career right now. For him, I think he was trying to figure out exactly what he wanted to do and was looking, as an opportunity to step back. And I think we both ended up in very similar spots, and both progressed throughout our career, in quite a parallel fashion, except for his move to grad school for a couple of years. But for me, I think I knew what I wanted to do. I was progressing, and I had the resources and the ability to take classes outside of work hours in order to get the training that I needed in order to help me progress throughout my career.
Right. So
I
that's
did take classes
interesting.
at NYU NYU's grad school, but I didn't formally enroll in the program.
Right. So that's interesting. I think that continuing education, the education was still important to continue to learn as you're going throughout your career. And Jane, undergrad in economics as well, and then a PhD and an MA in business economics, which is finance. How much did the three of those degrees help?
So I kind of am very much in Erin's camp. When I graduated with my BA, I thought I was done. Started at JP Morgan Investment Management and Quantitative Fixed Income. But then as I worked, I realized I wanted to become a professor. And I did become a professor at Dartmouth.
Right, at the Tuck School, right?
Tuck School of Business.
Yes.
Exactly. And so I had to go back and get my PhD, and I was just interested in it. And when my friends heard that 4 years after graduation, I'd entered graduate school, I think they didn't believe it. They fell off their chair. They're like, "You're kidding. That's not who she is." So I think the point of it is it's not so much about what degrees you get. They talk a lot about grit, curiosity, finding out information. It can be in a formal structured program. The world's changed so much. They're not the jobs anymore where you go to a certain school and then you go and from there take another job. And, you know, yes, those opportunities still exist to some extent, but the world's changing. Even the big investment banks, they used to be just, you're not coming in as an associate unless you have an MBA. They've totally changed. And people are really much more interested in who you are and your ideas, and you just can't ever stop learning. Too many people, I see too many people feel like, particularly I think young women hit this space where they'll study for a while and they'll learn and then they'll say, "I'm done, and done forever." And I mean, even me, I'm still continuing to learn, learn new things, learn new programming languages, learn new things. And it's really important.
That is so liberating to hear that Wall Street, that you don't have to be the cookie cutter MBA, and that's the only way you're going to get in the door for a professional job. So Katie, how critical to your career? You had a BS in finance, MS at MIT, PhD in finance, chartered financial analyst. So clearly continuing education has been a theme in your life, but how important, were those degrees, the educational degrees?
Well, I pursued them in part for reasons like Jane. I loved education. I loved learning. I loved teaching. And I thought potentially I'd do the academic career. Turned out that I'm not really well suited to being a full-time academic. So CFA Institute was in the middle. But I'm older than my fellow panelists. And when you go to college in the 70s, there are not a lot of female role models, and certainly not a lot of people inviting you to Wall Street or to have an investment finance career. I kind of had to flounder my way through. I started with economics and realized that I had a much more practical bent, ended up in the business school, and tried a couple things along the way. I tried corporate finance first at DuPont, hated it, too bureaucratic, too boring. Tried consulting in New York City. Once I learned the shtick, it was too boring. So I went and I thought, well, I'll pursue my graduate credentials. But along the way, I wasn't always respected. And
that's interesting.
The PhD opened doors, particularly outside the US, particularly in places like Japan. People would talk to me and say, "Oh, Dr. Sherrod, yes, you can speak at our meeting." It definitely opened doors for me. And I think that's partly my age. And I'm, really hopeful that other women coming along now won't have to get to choose whether they want the education, not that they need it.
So that's really very insightful. And I don't know whether it is a generational thing or not, but we'll talk about that a little bit. But Erin, you mentioned that you kind of knew where you were going. Is that right? So did you have a clear sense? I mean, that you were going to be in, multi-sector asset allocation, target date funds? No, you didn't. So what was your goal when when did you kind of figure it out? Because I had a very circuitous route as well. But when did you figure out, what was your goal when you graduated?
So I didn't read the Wall Street Journal every day as a 10-year-old. I don't even think I knew really what finance was. I actually started at Georgetown in my undergraduate studies pre-med. And I think it was my sophomore year where I took a macroeconomics class, and I just loved it. And it was, sort of very eye-opening to me. I'd never taken an economics class prior in my studies, and I really just loved it. And I decided that's what I wanted to pursue. And so my junior year of college, I applied to a number of investment banks for different internships, honestly, mostly because that's where all my friends were applying, and I wanted to spend the summer in New York with them. But I was able to get a job, a couple of jobs from Goldman and from Morgan Stanley and from Lehman Brothers. And I took the job from Lehman Brothers because it was the only firm where one of my interviewers was a woman, and she was actually pregnant. And it was, I could see myself like her. It was the only person I could really relate to at all. And that honestly was the start of my career in finance. And I went to Lehman, worked there for the summer, absolutely fell in love with the energy, with the dynamicism, with the fact that every single day was different, and I was never learning, the same thing twice. And I could really see myself in that environment. So I joined after college, Lehman Brothers, in the investment banking program, and that was really the start of my career. But I think once I was really there, experiencing it on the floor in my junior, internship, that was really it for me. I knew that was the right, sort of career fit. Right. For what I wanted to do.
So I'm, because I looked at, a list of firms that you were, that you were with, and, you were with banking firms as well. So Citigroup, Neuberger Berman, were those strategic choices? Were they kind of random choices? I mean, how did you decide, what firms you would go to?
Yeah, it definitely isn't random at all. I'm really introspective. I'm really good at sort of self-assessing what my flaws are. I'm probably the most critical person of myself in the world. But that has enabled me to really look at what I'm weak in, what I want to learn more from, and then go to firms where I feel like I can learn from, the environment, from the firm, from the culture and the people that I'm with. And so when I moved to More Capital, which was the first hedge fund I worked at, it was because I really wanted to do macro investing. And they are one of the founders, one of the biggest influencers in macro investing. And so I knew that to get the best education, I would go there in order to learn. When I moved to SAC Capital, which became Point72, I went there because I was a really good research analyst, good at crunching numbers, assessing the data, but I wasn't the best trader. And so working for Steve Cohen, I knew I would learn how to trade better than any other firm. So I've really used the firms that I've gone to as strategic sort of ways to really increase my knowledge in areas that I thought I was weak.
That's so interesting, because a lot of not investment, but career advice people, would say, go with your strengths. Don't worry about your weaknesses. In fact, you were filling out your portfolio, as it were, your resume portfolio and your skill portfolio.
Yeah, I mean, I've used it as opportunities to, really learn, to benefit myself, to make myself better. Right. Obviously, I was bringing something to the table because that's why they were hiring me, but I was pretty strategic in the places that I went.
Yeah. And Jane, you described kind of the various things that you've done along the way. So what was it that clicked? How did you end up with, co-founding PIMCO, for instance? How did you end up in the hedge fund world?
I'm a total accidental entrepreneur. Maybe just to give you a sense of my story, I think the one thing that I have done well in my existence is recognized opportunity and taken it. But my college advisor asked me what I was going to do when I graduated. And all I knew about was investment banking. This was the early 80s. And I said I didn't want to do that. That sounds horrible. And I still remember him looking at me and saying, well, there are a few other jobs in finance, It's not all banking. And he sent me down to meet with a former Wharton professor at JP Morgan, and we hit it off. And he basically asked me to come work for him like a graduate student, in more of a graduate student type role, even though I was employed by JP Morgan, but it was more of a graduate student role. And from there, I I had another opportunity, which caused me to move to the West Coast. I was an athlete. I got an opportunity to train for the Olympic trials. So I went to him and said, hey, I've got this opportunity to do this. And he said, I'll give you a 2-year leave of absence. I went to the West Coast and discovered hedge funds, and then didn't come back, and then went to graduate school. So it's always been, and when, I quit a job, clients called us up and said, I didn't quit to found PIMCO. Clients called us up and said, we want to transfer the money. So, I think if you do good work, you kind of make your own luck. You kind of make your own success. I feel like today there are too many people who are focused on what is the right career progression. I'm going to do this and this and this, and
Right.
life never works out that way. And what you just need to do is do what makes you happy, do a really good job at what makes you happy. Those two tend to correlate. If you don't like what you're doing, I can guarantee you're probably not going to be very good at it. People enjoy doing what they're doing and adding value. And I think then people recognize it. And whether you're asked to join somebody's team, whether you get a promotion, whether clients want to hire you directly, that's the way it. I have a lot of friends who are consulting, and some of them went into consulting thinking, oh, I'll jump to the industry. Well, that doesn't happen. It was sort of the successful client, the successful consultants that the clients asked to join because they enjoyed what they were hearing and, the work you were doing. And if you're not excited, I think what Katie said, which is really important, is don't be fearful of trying a few things. And if you don't like it after 2 years, switch. And you just haven't found your home, but there's a home for everybody. And don't force yourself to do something you don't like, because you're not going to be very good at it, in my experience.
So Katie, your route, which you described to us as far as from the educational point of view, but why did you choose the CFA Institute, the Chartered Financial Analysts Institute, which is the largest trade group for investment professionals? How did you end up there?
My career story is very similar to Jane's, except we just substitute in different situations. And
Yeah.
The way I went to New York is I went to a party in New York with my then boyfriend, now husband, sat next to somebody who asked me how I liked my job, and I said I hated it. And that one thing but you have to be authentic, right? You have to be yourself.
Right.
And he liked me. He thought I was intelligent, bright, whatever. He said, he asked me half a dozen questions. He said, you would be perfect for the subsidiary of ours. I'm gonna have the president call you next week. They did. I interviewed. I got the job. I took it. You have to be opportunistic, and you have to be honest with yourself and with the people you're talking to. But to your question, I was at the University of Virginia because my husband was a professor at the University of Virginia. We married when we were both in New York. He was on a leave of absence. And I knew that I wanted to get a PhD. And so I went into the PhD program, and I had been teaching undergraduate at UVA. Mm-hmm. And since I was teaching at UVA, I was eligible to grade CFA exams. So I started grading CFA level 1 exams in 1983, got to know a lot of people, and just like the story, they said, well, when you graduate, would you come work for us? So I had to choose between academics and practice. And I knew I really wasn't going to be the publish or perish type of person, although I loved teaching and I loved research, but I wasn't sure I loved that lifestyle. And I knew that I didn't want to be all in for-profit big company. And so I was like, sure, I'll do this for a couple of years and let's just see, maybe I'll meet somebody. I'm going to be working with a lot of great investment firms. And I did. And it was going to be a stepping stone. There was
19 years later.
19 years later. But what I found was I joined at the exact right time for me, because I got there when it was small, and then they started being global. I got a lot of global travel. I got to build various education programs. I worked with a lot of people. I worked with Rob, as you know, prolific speaker. I was head of member education. I was responsible for the board planning committee and strategy. I had some great opportunities. And for 15 years, it was everything I wanted. Middle of education and business and practice. I learned a lot. I met a lot of fabulous people in our industry.
And the Financial Analyst Journal, I mean, you
And,
kind of oversaw
yeah.
that, which Rob has published in, many times,
I
right?
hired Rob to be editor of it. So I hired him before
right.
he hired me. It's a funny story in our industry, in the firm. But yes, I hired him before he hired me. He liked the way I managed and how I worked with him. And, Rob is, as you all know, is a strong personality in our industry. And he liked the way I worked with him. And he asked me to come out and help him build research affiliates in 2006. So again, my story is kind of like Jane's. I mean, you take advantage of the situation. I knew what I wanted to do. I had made up my mind I was going to leave CFA Institute when I was 50. I'd capped out. I needed to move on. But Rob got to me before my 50th birthday. So there you are. So my planning didn't work. I had a great plan, but I was quick to jump off my plan.
I'm hearing, number one, that you all are risk takers. That's what it sounds like to me. That you're very kind of entrepreneurial, and also that each of you strikes me as having a lot of self-confidence. Even though, Erin, you said that you're your own worst critic, but have you always been this self-confident, or is this just a function of like where you've gotten? How have you built up your self-confidence?
Yeah, it's something that I actually speak to my niece about a lot. She's starting off in the industry. Both of my nieces started off in the industry, and definitely I see their lack of confidence, and I just want to instill it in them. And it makes me sad sometimes that when I hear them sort of self-reflect and self-criticize and not come in nearly as confident as probably their male peers into the industry. And, when I think about it and I reflect back in terms of my starting point, I definitely wasn't as confident as I am today. I think that it takes time. It takes confidence. One of the most important things or life lessons that I ever learned from my boss was when I started at More Capital, and I was probably 25 at the time. So I was really early in my career. And he said to me, I don't care if you're wrong, but I do care if you don't have an opinion. And the point was that I shouldn't have an opinion that wasn't well-founded, that wasn't well-researched. Of course he wanted a well-researched, well-founded opinion. But the point is that someone's hiring you for a specific role to do a specific job. And usually that job, especially in finance, is to have an opinion, to have a view, and to share that view. And so I think that really resonated with me. From there, I started to be more vocal. The more vocal you are, the more you want to research those views, and the more sort of prepared you want to be. But I think that really helped to build my confidence and, to instill with me sort of that I do have value, that I'm being hired by a firm for a specific purpose. And it's really to showcase what I can bring to the table.
Jane, self-confidence, willing to take risks, how important in your career?
I think very important. I think the bigger thing was when I had mentors, when I had a very prominent professor who, because I had a technical question, he was the only guy who could answer it. He became my mentor. When he said, I have a job for you, you were going to like this guy. And I got I think the best training program ever for those first 4 months at JP Morgan. We went through a new finance book coming out and essentially went through it all when it was still in its galley form and got state-of-the-art training. But I see too many people would say the response would be, well, let me go talk about this job. Let me think about this job. Let me compare it to other jobs. And I think particularly when you're young, and even at this age, when I've had mentors say, this is something you should really do and you should really consider it, as long as they know me well, I really, really take that seriously because they understand more than you do. And I've seen too many people who try to outthink it or read on blog posts and the problem with blog posts is that may be right for the person who put it on the post, but that may not be right for you. And I think the really big value of having a mentor or just having people who are older, who understand the system better to provide advice to you, who know you. So it's different advice to different people
Mhm.
is they have ideas about where you might really enjoy yourself. And when you enjoy yourself, you have a lot of success. I mean, for me, I really enjoyed programming and doing quantitative work. And that's the job, I got put into, I mean, to do generalized least squares right out of school with Fortran and mainframes. I mean, there's just not a lot of, you don't interview that way, and it's totally different than investment banking. And, that's just a very different place to be. So, there are people who know you well, who know more, and listen to them.
Right. Know thyself and know your mentors. Katie, what about you as far as self-confidence and willing to take chances?
That definitely describes me. I try to take informed risks when I'm willing to do it. I'm willing to make decisions and make big changes. I have a lot of confidence in myself, and I know that if something doesn't work out, I'll find something else that will. So I think people shouldn't be afraid. People listening today, don't be afraid of making a mistake. You can learn something from everything. You go somewhere, if it doesn't work out, you can still learn about yourself. What is it I didn't like? What is it I did like? Where am I going to look next? So don't be afraid of trying things, and you can learn a lot from it. And I would also echo Erin's point on people, speak up. I tell people when I mentor them here that I expect them to give me their authentic opinion, not what they think I want to hear. I already know what I want to hear. I don't need them to tell me what I want to hear. I already know that. What we hire bright people for is to give us a different point of view and to challenge us to be curious. So it's really important that, obviously you have to be prepared, and going and saying something off the cuff that's not thoughtful, pretty soon you'll be discounted. But if you do your work and you've got thoughtful ideas, you have to be willing to express them, even if they're dissenting views. That's how firms make good decisions, and that's how people get recognized.
So, and let me follow up on that, because I know at Research Affiliates that the culture is extremely important to you and to Research Affiliates. And you talk a lot about, if you look at the Research Affiliates website, about collective intelligence. So tell me, let's move kind of to the leadership issue now. And as a CEO, Katie, tell me about, the culture that you're trying to build where, people can succeed.
Right. Well, you mentioned collective intelligence. I'm a big believer in collective intelligence, and the idea that collectively, if we have different opinions and we work together with respect and curiosity, we're going to get to better outcomes. There's a lot of literature, research on that. And when you work in the investment industry, we have a lot of very bright people at Research Affiliates, PIMCO, wherever Jane is interacting now. I want to say, Pam, sorry, right. Jane, I'll get with it. But we have, and all of you that know Rob is a strong personality, but no one person in our industry knows everything. We all have blind spots. We all, we all have expertise in certain areas and biases in others. And we will make better decisions if we can give each other direct, candid feedback, even dissenting views, and then talk about it collectively. So what we need to do in the culture is make it so people are not afraid to speak up, show respect for different opinions, show respect for the process and so forth. And so we spent a lot of time on building trust, creating a safe environment for coming in. It's very scary, particularly for young people, to come and tell me they disagree with me, or to Rob that they, oh my gosh, we call it petting the tiger. That's very scary. But you're not going to accomplish what we're trying to accomplish if we don't create that culture.
Right. And the culture, when you can disagree with Rob or disagree with you, whatever, are they encouraged to do it in like a public meeting, or do you give them space to come into your office or area? How do you encourage that so that people aren't terrified? And
for me personally, I have an open door policy. If somebody wants to come and talk to me, I'm always all ears. Some people are more comfortable going up their chain of command, telling their, the partner in their group, and then that person will come talk to me. It really depends on the individual and how long they've been here. But most people that have been here for a couple of years understand that and don't have a problem coming and talking to me. They often come with trepidation and say they're very scared and nervous. And I also make myself available to groups of people. I'll have lunches periodically, maximum of maybe 6 or 8 people, where it's a small group. And the rules of the road are they have to provide some feedback or ask a question if they want to have lunch and if they want to spend time with me. And that I find that a lot of people are more comfortable expressing feedback or asking questions, which is a form of feedback, in an environment like that than in, let's say, an all company environment, which is pretty scary.
And Jane, what kind of cultures have you created at PIMCO and Martlet?
Yeah. I mean, I have really strived for inclusivity. One of the things I'm really proud about, and I didn't set out to do it, it just, it happened, is at PIMCO, even being so very large, over half of the partners were women or underrepresented minorities. I think we're one of the largest asset management firms out there. And I think that's the one thing people laugh about this. But I think the big thing that my PhD and being a former professor has helped me for has been a more inclusive environment. Because one of the things about the academy is you get all sorts of strange people with all sorts of strange beliefs. You just have to stand on your own 2 feet. I can see Katie laughing. And, you go down, I don't care, any institution, any undergraduate school, any graduate school, and people are really interested in the ideas. They don't care so much where your office is. They don't care what you're wearing. They don't care any of these other things. They don't really often care, whether you have tenure or not, and they're just going to talk to you. And I think that background laid a really good groundwork for having such an inclusive culture. And I think the reason we got all these people who, a lot of people turned down the major top tier investment banks to come work for us was because they just felt valued. And I think that's the one thing. It's not so much the technical skills that I learned that have been so valuable, though I did learn a lot of that, but I think it was more just you care about the ideas. And we had people who visited the firm and they'd say, this firm is the most eclectic firm I've ever seen. Most firms have cultures and you guys are all really eclectic. And I think we saw everybody as individuals with creative ideas.
Erin, at PIMCO, you managed some teams. PIMCO was, founded in 1971. It's a big established firm. And I know from just being a financial journalist, it's very competitive. Internally and externally, at least it used to be. So, what kind of culture are you creating with your groups at PIMCO?
It is competitive, but we're not competitive with one another. We're competitive with our benchmark or with our peer universe. It's a really collaborative firm. We hold a secular market forum once a year in which the entire firm gets together and discusses its long-term, sort of secular views over the next 3 to 5 years. That's really important because it's not myself or our CIOs who are presenting at that forum. It's actually our junior talent who spend, weeks and weeks, months presenting, putting together and researching their best ideas, their take on what the secular horizon is going to look like and those themes that they think are going to predominate. And they present it to the senior investment professionals, and then collectively as a group, we discuss. And so it's a way to get real buy-in across the entire firm. We also do that same forum 3 times a year in addition to focus on the cyclical environment. And so, we think about the cyclical environment as the next year or so. And that's really more designed to come up with sort of best trade ideas for the here and now, not for the next 5 years. So it's a way to really bring together the group collectively to get the best and brightest of both our junior talent as well as our senior investment professionals, sort of to debate, to discuss, to have a real discourse about, what we think the investment environment is going to look like. And so I found PIMCO to be probably the most collaborative firm that I've worked at. It's one of the reasons that attracted me to the firm. Mm-hmm. And it really, I think holds true to, its intention in being collaborative and, certainly being very competitive, but being competitive with ourselves or, internally, self-competitive, pushing ourselves to, deliver the best returns, but then also certainly being competitive relative to our benchmarks and our peers.
Here we are climbing the pink wall, and you've all done it. But Katie, you mentioned the fact that, getting a PhD was a big step in getting respect professionally. So, how do you attribute your success in climbing the pink wall, of breaking through, that glass ceiling?
We mentioned some of it: confidence and risk taking, and I think continuous learning. You got to keep learning. You can't slow down and think you've got it and you can cruise. For me, I'm a goal-oriented person. I like setting goals. I like solving problems. And for me, I continue to find places where I could do that. And I found I have skills that a lot of people don't have in solving problems, particularly the thornier the problem, the better for me. The more different points of view, the better. I learned that at CFA Institute. CFA Institute is a very strange governance animal. And all of the different points of view coming from the different firms and the different geographies really took some diplomacy, if you will, in trying to weave together a lot of what people wanted with the goals of the organization. So I learned some skills. I learned I was good at it and kept building on that. And I don't know how to say it, but I just don't let the little slights get me down. You can't get you got to look at the big picture. You've got to take the long view, because if I had gotten upset at all the things that went wrong in my life and the people that didn't listen to me or didn't want me in the room, I wouldn't be here. So you've got to take a long view.
And what barriers still exist that need dismantling, and what are you doing to dismantle the barriers that exist for women to succeed and minorities to succeed? And
we're doing a lot of work right now in learning, particularly this summer with George Floyd and all of the issues that we've dealt with as a country, and looking to see where we have our own biases, unconscious biases, and where our practices are inadvertently creating barriers to achieving the type of diversity and equality that we say we want and we actually do want. We've reiterated several times. There are a lot of unconscious bias. I love Iris Benet's work at Harvard on unconscious bias and how to be deliberate in getting to change. And so we've been,
for example, how are you being deliberate in getting to change?
Well, so I'll give one example, and the research is pretty clear that women on a whole, maybe not the three here, but women on a whole tend to be a lot less self-promotional than white males.
Right.
And in a lot of the promotion and hiring criteria, if you have a stereotype, a bias towards what success looks like, it often is described using traits that fit men, often white men, better than women. And if you do annual self-evaluations, and I've seen it firsthand with men and women that report to me, and I would put myself in the less self-promotional camp relative to the white men that have worked for me, that if you take those away from the context and somebody else looks at them for promotion, and you just read what people have written in their promotion, in their self-evaluations, you're gonna say, oh wow, this man, this white guy, looks like he's got all the criteria we want. So you're inserting a bias into the process. And so we're looking for those types of biases and finding alternative ways of developing people and assessing people and respecting what we truly value, not necessarily how they show up or what a stereotype or bias might suggest is the right person for a particular job.
So, Jane, how do you explain kind of your success? I mean, you might have discussed it as well, but what are the barriers that still exist for promotion and entry into the financial services industry, and what are you doing to alleviate them?
So there's a lot of things. I mean, I'm very proud that I was one of the founding board members of Girls Who Invest, which is, a fantastic organization. And I know Erin's on the advisor, one of the advisory boards now, which is fantastic. But I think the big thing, and Katie said this really well, which is just don't get hung up on the slights. I mean, it wasn't it was just a few years ago, and okay, I'll brag a bit. I'm a pretty strong quant. I taught some really tough classes at a tough school that had a lot of engineering students in them. And I was with a gentleman.
Maybe not a gentleman.
Well, no, it was with a gentleman, which is fine. And actually, Consuelo was a reporter who asked him, well, since Jane's so soft and you're the quant, what's she bringing to the table? And I'm just sitting here going, okay, this is so backwards. But you let it roll off your back. And I think I've seen too many women who get upset about something and then just, don't move forward. And you got to realize everybody's got different life experiences. I'm sure everybody in the world can be upset about something, regardless of their race or sex. I didn't get the promotion I deserved or whatever, but what you have to understand is that your career is over a long, long period of time. As long as it's going in the right trajectory, you're doing well. I do think we've made a lot of strides in diversity, and we can continue to do better. But I think the real problem today that I observe a lot is inclusion. Mm-hmm. And I can't tell you the number of times that little story that I just told you, I've seen happen with other people. For example, we need a really strong Mack-E to solve this problem, mechanical engineering person. And then there's a woman who's a Mack-E, but for some reason it just didn't register in people's brains. And so I think one way to gain confidence and to feel positive about things is, rather than promote yourself, promote somebody else. So if you see somebody else not being included, if somebody says something and it's like, well, but Sally here, she's a mechanic, let's ask her. You've gained a really good thing because you've spoken up. It's often easier to speak up in somebody else's behalf.
Right.
And the world, I believe, has karma. And as that goes around, and sure, there are people who aren't bad team players who never say nice things about anybody else. But in general, if you act that way, other people are more likely to act that way, and you can really change the dialogue. So, you can think about promotion for yourself, but you can also think about, well, who around me isn't really getting hurt? And let me have a plan to speak up about that. And that's a good first step, because then it becomes easier to speaking up about yourself. I think it's a lot harder. I know it's harder for me to speak up in my own defense,
right.
What, am I chopped liver? I know a few quantitative things more than this guy does, I can guarantee. And it's just hard.
Erin, as far as, what are the barriers that you see still in the industry that need dismantling, and what are you doing to try to overcome them?
Yeah, so I think that, a lot of the comments that were made just now, I'd echo. I think that we've come a really long way over the last decade or, 2 decades in terms of hiring practices, particularly around junior talent. And, you see that with Girls Who Invest, where a number of firms, PIMCO is included, and one of them is really trying to build this pipeline of junior talent within the industry. I think where we still have, issues is really as women age into the sort of middle tier of their lifespan. And we see, many women who don't progress nearly as quickly as many of their male cohorts, who maybe leave the workforce because of, other personal, sort of demands on their time. And so I think really devoting time in terms of not just attracting talent in the industry, at the junior levels, but also policies around retaining women at the mid-level career points is what's really important. And I think that's where we see the biggest sort of hindrances to future growth of women in the industry. We have a really tough time hiring talented women at the senior level. And that's just because there's not a lot of them. And because a lot of women leave the career, when they're in their early 30s or mid 30s, and, they want to spend more time at home. And so
with their families, right.
With their families, right? If they have, either personal obligations with raising kids or with their parents taking care of them, or just, want a different focus and different mission in life. And so I think that's where we're really focused on devoting attention to at PIMCO, myself personally, in how do we sort of create policies that can retain and attract women throughout their career, so that they don't feel like there's a better alternative out there. The other point is, and I think Katie mentioned this, one of the ways that we're doing this in terms of our hiring practices is that we're whitewashing the names on resumes. So it makes it gender neutral, it makes it race neutral, it makes it, neutral across all sort of factors. And then you can really evaluate a resume, a person, based on their academic and work experience merit, rather than based on what your perceived notions are of based, on their name or, what their gender.
So we've got a couple more minutes before we go to questions, but Katie and Jane, do you want to respond to Erin's observation that it's hard to find women for senior positions, that have you also witnessed this drop off in women who are with families or, caring for an elderly parent? Or Jane, you're saying no.
No, I mean, obviously there are situations where that happens, but I guess I've been more around the world of hedge funds and more around the other world where there can be room. And, people talk about this, and
right, they do.
It annoys me more than a little bit, but you've had like some very high profile women leave, and, they've been the deputy PM at a big hedge fund, and people will talk about, we want to find women hedge fund managers, and then they'll leave and people will sort of soft circle money, and then it doesn't arrive. And, I think what's happening now, and this was a big concern when I was running PIMCO, is we were seeing the top people that we wanted. And, most of the people who came with us turned down other places. They were going to tech. Amazon was taking them. And, we needed a more technical background. So, we sort of fit in that hole. But I think what's really discouraging in asset management is if you look at the three of us, we're sort of early, but if you go down 10 more years, there are even fewer women, because they're not seeing, people aren't walking the talk. And that's just been my experience, very much so. I mean, that's why PIMCO existed, is we looked beyond and found we had a lot of minorities and women running money because they couldn't get the money directly, and the numbers were better than, it's sort of funny. This is a numbers business.
Right, it is.
But people don't look at the numbers. They explain it away. Oh, she got lucky, or he got lucky because he didn't go to an Ivy League school or whatever it is. And, it's a real problem. And so I think that's just, it's, I don't know what the solution is, but I'm working with one of the major research universities out there on a project to try to help fix this.
And Katie, do you want to chime in on that? And then I'll ask Nella Webster to join us with some questions.
Absolutely. I think Jane described it well. If there are a lot of slights in women that have gotten as far as we have, there are a lot of really good women who say, I'm not going to deal with it anymore. Like Jane's example of assuming that she didn't have the quantitative background. I've dealt with it my whole life. I'm sure Jane and Erin have too. And just a lot of people say no more. And part of that is, if you don't see women in senior roles, you don't see potential in the senior roles. A lot of the literature I've read, the visual cues are as important as the words. And if you don't have evidence to match your words, then their biases and their stereotypes and their problems that are preventing you from accomplishing what you say you want to do. And that's the hard work that our industry needs to get going with if we're really going to make a difference. It's not just that people are going because they had a child. I mean, that's what somebody says when they walk out the door, because it saves face. But that doesn't describe why we don't have enough women in our industry. There are a lot of reasons, and some of them other industries are more attractive and welcoming. I think that's a fair assessment, but we got work to do.
Yeah.
And just to be clear, I wasn't implying that women are leaving mid-career because they want to have babies. That's absolutely not what I was implying. I was just saying that many women leave mid-career one of the reasons is to focus on their families. Other reasons is because they're going to other industries or they're, have a perceived flight. But I do believe that what we need to focus on is retention policies around keeping those women, figuring out why they're leaving and rooting that out so that we can have more of a real pipeline for talent to the most senior levels.
Right. So you're not seeing that kind of bleed out with men at the middle level then.
I think you need both.
Not as much.
I think you need everything
Not as
Erin's
much.
talking about, plus people need to do some self-introspection and see what they're doing that is creating, blind spots or hidden hurdles.
Right. So, and again, I'm giving Nella Webster, who was going to ask some questions from the audience, a chance to come on. So whenever she appears, we will make room for her. There you are. Nella, do you have some questions from the audience?
Thanks, Consuelo. We have many questions from the audience, and I'll try to get through as many as we can in our time frame. We had a few that dealt with the first half of the program, but I've been inundated in the last 15 minutes with questions to the panel on their careers. And I think some of it is because we have a large number of students here in the audience. So I'm going to start with a couple of those questions. And then there's some that are, I don't want to say more cultural or personal, but I thought they were great questions that I'll pose to you before we finish up the Q&A session. The first one is career-related questions for any of you. So advice for women in college trying to get into the alternative space. So the questions that came out as a result of that was, do you jump into it if possible? Do you try to go into corporate finance first? Do you try to go to asset management or consulting? Is there a career path of sorts? It sounds like each of you got into it in opportunistic manners, but if you've got some comments for what these students should think about or look for in terms of internships, that would be great. And a couple of questions came in related to that.
Okay. And Jane, do you want to take that first?
Sure. So, okay, now just another piece of realism. This industry is one of the most competitive industries out here. I mean, asset management, finance. It's incredibly well paid, but there are a lot of people who are trying to get into it. So first off, if I were advising somebody, I think people really need to think about if you really want to do finance, at least for the starting of your career, that is all you're going to do. And if it's your goal to, I'm going to graduate from college, I'm going to get a finance job, and I'm going to go work on a blog that follows restaurants, and I think I'm going to learn how to sail. That's not the job. And so I think there's a lot of people who get very frustrated because my experience, almost every interviewer is sitting there asking themselves, is this person going to stick through it, through thick and through thin? So to that extent, in order to get a job, I would start anywhere. It doesn't matter where it's alternatives or not, but whether it's through high grades, whether it's through just working really hard in an internship or working really hard in a paid job, you just need to show that you're determined and you can stick through the ups and downs. And I see too many people who come to me and want advice, but they're not really dedicated to it. And I think we do a disservice to the world by not explaining that. I mean, I am going to guess that I don't think Katie, Erin, myself, or even you, Consuelo, or probably Nella, has ever worked a 40-hour week. And this is just, it's a reality. It's like being in your internship or residency as a physician. It's just a reality. And unless you're willing to really accept that reality, this is not the industry.
Very
Would you
good.
two agree? So Katie and Erin?
Nothing to add.
Okay.
Yeah, absolutely. I mean, I started in investment banking, which is, notoriously sleepless days, hours. I didn't take a vacation. I didn't work, have a weekend for several years. But, there's a camaraderie, particularly with working with like-minded, people who are your same class, your same cohort. So I really enjoyed it. That said, for me, I think the best place to start out is, I always say it's at an investment bank, whether it's in sales and trading, in investment banking program, or in the research department. And I don't say this because investment banks are necessarily are the holy grail of finance. It's really because they have long tried and true tested analyst training programs where it's really regimented program. You get an incredible education in corporate finance that really prepares you well with fundamental skills to set you up for a career in finance. So, it doesn't have to be an investment bank, but what you're looking for is a really solid training program, whether it's at an asset manager, at an alternative asset manager, or at an investment bank. And the investment banks have the longest history of being able to really mold and develop good analyst talent. But there are some asset managers that are starting to develop really great programs as well. So I think what's important is when you're in your first 3 years out of undergraduate studies, you really want to focus on getting a very strong skill set in corporate finance and in sort of the fundamentals of investing.
Erin, you answered 2 other questions that people had, so thank you for going through and explaining that. One of the other questions, how do you find as a woman balancing between being vulnerable or being yourself in a male-dominated industry?
Katie, do you want to take that? Because you said that you become more and more outspoken and that you're just going to say what you think.
Let me say that I have been too outspoken for many men, and it's been uncomfortable in my career. And I have moderated and been more thoughtful going forward. I think the bottom line is you need to be thoughtful about the person on the other side. It's really short-sighted to go in and just charge right in and be yourself. You need to also think about the person on the receiving end and play the long game. So my advice is be thoughtful about how you express your opinions, how and when. One of the other things I've learned in my 20s, I didn't realize that people were so different from me, that there were introverts, for example. And so I'm much more thoughtful later in my career to how introverts process, and they'd rather think about it before engaging in a conversation, as opposed to a pair of extroverts could just go at it and talk and work it all out and be done and move on. If you're working with an introvert, that might not be as comfortable or successful.
Thank you. Thanks. And this is more of a general question. What do you see as the impact of behavioral finance or investment on the market? I think that came from a professor.
So I think all of you have done work on that. Who wants to take that question first?
I'm going to take that for one quick second, which is, I think what behavioral finance is it's realizing that stock and bond prices just don't move on their own. That people do things and people hold on to their losers rather than sell their winners rather than doing the same. So I think that's important. I think where it gets very dangerous, we're all sitting down, we're not doing this in person, but if you saw me, I'm 6 feet tall. I used to high jump, so I'm tall. And, the reality is women tend to be shorter than guys, but I'm taller than a lot of the guys I meet. And I think where it gets very dangerous is when people start thinking about, well, women tend to do this or be more risk averse or something or other, and they start promoting stereotypes. So I think behavioral finance is a fascinating thing. And I think it's reality. It's how the markets move. But I think you want to be careful from taking lessons and then putting people into categories, because it's just not often true.
That's great. I'll go ahead on to the other if
yes.
No one else has a suggestion there. How have you gone about advancing, and how have you found sponsors strategically? I think mentors have played a role in all 3 of your lives, but are there any tips for those that are starting their careers now?
Getting a mentor, you mean? How do you get a mentor, or?
Yeah. Or somebody to sponsor you through the ranks. I mean, there have been a couple of responses, so this may have been a question that got answered somewhat, especially with Katie and talking about her moves. But, are any suggestions on finding someone to jump on their wagon and move along with them? Because I think that often has helped many, many successful women be able to get where they are today.
Erin?
Yeah, so, I'm really glad that you used the word sponsor and not mentor. And I think that there's an important distinction between the two. What I found in my career is a number of really great sponsors throughout my career that have helped elevate me and put me in positions of success. But those weren't people that I had as a formal mentor where there was, an assigned mentor relationship. Sponsors are people that work with you or in an adjacent, sort of group to you that can advocate for you throughout the firm. Whereas a mentor is someone you go to for advice. A sponsor is someone who has more of a direct control over the advancement of your career. And so I've gotten a lot of, I think, value out of sponsors within the firms that I've worked. And the way that I've really engineered that is by doing a lot of work first to elevate your sponsor. If you make them yourself critical and crucial to them so that their success is dependent on you, then they're going to pull you up as they rise throughout the ranks. And so I've had that be really successful as a strategy for me throughout my career. And it's something that, I don't ascribe a ton of value to mentors because I really haven't had mentors throughout my entire career, but I have had great sponsors that have helped, significantly in my career advancement.
Anyone else?
Articulating the difference. Go ahead, Katie.
I haven't. I never had a direct mentor, but I've certainly had a lot of people I respect and who have given me good advice and advocated for me over the years. But I have spent a lot of time giving back in the last decade in particular. I've done it my whole career, tried to coach and mentor. I think coaching is a better word for me. Coaching people through their careers. I coach predominantly women, but I also coach men and minorities of all kinds on how to express themselves and how to navigate in this type of environment. And I think that's very important to have a safe place where you can ask your questions and get candid feedback.
That's great. That's great. Okay, and maybe this might be a final conversation there. A lot of people were asking about work-life balance because obviously you're passionate about the job. And I don't know if saying, what do you like to do when you're not working? Because that's sometimes the challenge. But I think the audience would love to hear about the other side of your life and what you do when you're not running these wonderful organizations that you're involved with.
Erin, do you want to start?
Sure. So I sit on a number of boards. I'm on the advisory board of Girls Who Invest, but I'm also the treasurer of the board of the Ecology Center, which is an environmental-oriented sustainable agriculture nonprofit here in Orange County, which I'm really passionate about. I also love travel. I'm a really avid traveler, not right now, unfortunately, but I'm also a really avid scuba diver. I'm a PADI certified scuba dive instructor. So I try to be in the water diving as much as possible when I'm not working.
Katie?
I used to play a lot of tennis, although I don't as much now. My back and knees don't tolerate that very much, particularly with the hard courts out here in California. I grew up playing on grass and softer surfaces on the East Coast. I love travel. I love just getting out in nature, whether it's a hike or whether it's out on the water or something else. So I love that. I have two boys. One is in Taiwan right now. Unfortunately, it's very hard to see your children when they're in this COVID environment, when they're so far away. But I used to love going and visiting him, and one's in medical school. So when I have time, I try very hard to catch up with my kids, my broader family. We try to get together regularly, keep that going as best we can as we're scattered around the world.
And Jane?
Two things. I've learned how to be loud and talk because I used to be a professor, but I'm actually an introvert. So I really like cuddling up with a book, whether it's fiction, nonfiction, or a textbook, teaching myself parts of physics and other things that are interesting. But then the other thing I really am passionate about is education. And I try to do a lot to help bring education to all sorts of different levels. And I'm on a lot of advisory boards for educational institutions.
Great last question, Nella.
Good, thank you. And what I'm going to ask in a moment is that the panelists, Tom, Angela, and the people that have been responsible for putting this on, come back on the video so Angela and Tom can give a few closing comments. But I do have to give a shout out to Jane, because one of the things that came through is how much Girl Scouts love WISE and appreciate all that we've done. And they're very proud to have you as a Girl Scout, Jane.
So where is Rita and where is Joey? I don't see them here. And Fidel, you too. Where are you? Okay. Tom, you go first.
Well, thank you all. What a great panel. Although, Jane, I'm not so sure that being a professor is what teaches you to be loud and talk a lot, but that may be the case too. Thank you for taking this afternoon or early evening, depending on where you are, to do this. The insight, especially those questions towards the end, I know are really helpful to at least our students and other partners, and it's an exciting event. Thanks.
Yeah, it was, and thank you all the panelists, especially I have to thank all of the Chapman team, Rita, Joey, Fidel, all of you that were so critical in getting this thing to go off. I feel like this is the Oscars, but I'm going to go on. I want to thank the WISE Board of Directors who put a lot of time and effort into getting this off the ground. And we had a marketing committee, Stephanie King, Rosemary Pugh, Casey Buhari, Trey Lewis, all helping all in their own way. We have Tina Shackman, who's on our advisory board, who brought in the CFA, and of course Nella, who straddles both sides here with Chapman and WISE and made the introduction to Tom in the first place and to the whole group. And I think, and
thank you, Angela.
And I also have from Joey, we have a survey at the end. So anybody that's still around, please fill out the survey. And it was just the greatest evening. So thanks to everyone. It was wonderful.
Thank you, everyone.
And we can't wait for the next one. Next time.
Take care.
Take care. Bye.
Thanks so much.
Thank you, Angela.
Bye.
Bye.